As lawmakers debate the next round of stimulus, our next guest says more relief could be a short-lived sugar rush for the markets. That was the subject of his recent piece in the Financial Times. Joining us now is Ruchir Sharma, Chief Global Strategist, Head of Emerging Markets with Morgan Stanley Investment Management, and the author of The 10 Rules of Successful Nations. Does the continuing stimulus, in your view, Ruchir, violate one of those rules?
Yes, absolutely. I think that that's really what's happening across the world, and the U.S. is doing it in a way that few other countries are. You know, the one key statistic I keep quoting, and which is also there in the article that you referred to, is that 20% of all the dollars in circulation around the world were printed just in 1 year, which was 2020. So this is the incredible amount of stimulus that we have launched, especially in the U.S., and the other countries have also followed suit. And this is happening at a time when we are already seeing signs of an economic recovery take place, and we are piling on with even more stimulus. So the natural conclusion that I reach here, and I think it's being underestimated, is that inflation has been missing in action for the last 30 to 40 years, and betting on rising inflation has been the surest way to discredit yourself. But I think that we could finally see that, because just what we are experimenting with this year is truly extraordinary and something that has never been done before at this scale.
Ruchir, we take solace in thinking that that inflation is sort of needs to simmer for a while before it can come back. But you make an interesting point that the impact of business closures, it has a deflationary impact, but then it results in supply shortages, and that could quickly turn into some pretty big price gains when demand comes back and nobody's ready for it. So is that possible, that an inflation switch can just be switched on, or will we have plenty of advance warning?
No, I think that this has been building for a while. So if you look at it, I think that we're at the opposite moment of the early 1980s. At the early 1980s, when we were so convinced that inflation was here to stay, once disinflation set in, it set in very quickly, and you got a very rapid decline in interest rates in the early 1980s. I think that something opposite could happen here over the next year or two, which is that you have an uptick in inflation and a much more pronounced increase, especially in long-term interest rates, than what people are anticipating. The issue with forecasters, and particularly with economists, is we all tend to think in incremental terms. You know, so the inflation forecast or growth forecast, everything tends to be very incremental, that, okay, it'll move from 1.9 to 2.1, that kind of stuff. But my point is that we could be at that major turning point here, where the jump could be far greater and far more discontinuous, because we are really looking at a very big economic boom, I think, later this year. And there's a limit to how much the economy's supply side potential can even tolerate a big boom in demand that I think is in place. We have this huge savings windfall that the consumer is sitting on, massive amount of discretionary pent-up demand, and on top of that, we're throwing in even more stimulus. So this could lead to an overheating situation much more quickly than the forecasters today are anticipating.
Shepard Smith here. Thanks for watching CNBC on YouTube.